Bill Smead is founder and CEO of Smead Capital Management and portfolio manager of the Smead Value Fund. He joins us each week to demystify the stock market. Bill, thanks for being with us for a whole new season. What a week to start with. President Bush and Treasury Secretary Henry Paulson announced this huge bailout to try to stem the crisis. It's a good move, you think?
I do. I actually think that hiring Hank Paulson to be the Treasury Secretary and David Petraeus to be the guy that headed up the effort in Iraq will end up being a couple of feathers in President Bush's cap. Right now, there's so much panic the last week that nobody stopped to think about that. But I think that Hank Paulson is a huge success as Treasury Secretary.
Now, some people say we're pushing the panic button too soon. We're not going to go into another, Great Depression like we saw in 1929. Why do this now?
Well, that's a terrific question. They're shoring up the money market funds, which are not insured deposits, and they are the area that could see a run on the bank similar to the run on the bank that occurred in the Depression, because since they're not insured, they're more open to fear. And if people withdrew their money out of money market funds and put it into an insured deposit at the bank, then there would still be money to lend. But if it went out of there into the backyard in a can or into gold bullion, it would be a massive contraction of credit. And the purpose of what they're trying to organize is to reopen normalcy in the credit markets.
And stop the panic, because as you say, it was almost getting to that point, and maybe the risk of not doing something was greater than the risk of doing something.
Right. That's what they did, cost-benefit analysis. That's exactly what they did, and I happen to agree with them. This is the first time in my 28 years of being in the investment business that we came this close and have been staring the possibility of deflationary depression-like circumstances created by a collapse in the credit market.
The individual investor now, maybe this is a good opportunity. I mean, we don't know whether this is turning the corner or not. Maybe you don't know. I don't know. Do you want to look in your crystal ball at all and say?
Well, in my conversations with clients this week, I commented that if they have to go through depression-like circumstances in the next 2 or 3 years, they should realize that in 1930, 31, and 32, if you owned IBM, if you owned Coca-Cola, if you owned Merck, if you owned General Electric, you ended up having a better asset during that decade while the Depression went on than you did if you had money in money markets. First of all, back then, many banks failed, so many people lost their savings.
Right.
But in totality, you came out better owning those than by hiding.
You think that'll happen again? I mean, you think you should just hold on?
Well, I think that you should maintain the quality level associated with knowing that. See, in the worst case scenario, the price of everything drops. So if, for example, your investments drop by half, but the price of everything goes down 70%, and you have assets, you actually have more buying power at the end of it than you did at the beginning. And when we get in these panic modes, we forget what the best stores of value are. Gold attracted money this week under the store of value idea, but it doesn't pay any dividends and it has no possibility of future earnings growth, and it's not a productive asset, it's just a good currency.
What about Washington Mutual? I mean, at one point it was down to $1.75 a share. Is it now a good time to snap up the bargains?
Well, I thought originally, say in January, that they got themselves in a position that it was a 40% possibility they'd make a comeback, 40% possibility that they'd get taken under, which means get bought out at such a low price that it was no big advantage to long-term shareholders, and a 20% chance that they might not make it. I would have said 40% a week ago that they might not make it, 40% that they'll get taken under, and 20% that they'll make it all the way back.
So everything changed.
And so everything changed. And so what I believe that's going to make sense is that a financially strong institution like JP Morgan or Wells Fargo will look at the positive side of Washington Mutual, which means their wonderful deposit base, their locations, the states they operate in, and someone that is weak in those regions would take advantage.
Back to the government intervention now. I mean, we're talking a lot of money, hundreds of billions of dollars. Isn't that going to come back to haunt us eventually? I mean, aren't we going to have a huge federal deficit or pay more taxes?
That's a great question. I'm reading a book called The Prize by Daniel Yergin, which was a Pulitzer Prize winner in 1993, 92. He said in 1982, Mexico was going to default on $85 billion worth of debt, and that almost bankrupted our money center banks in 1982. 85 billion then, 26 years ago, is way more money than $500 billion in terms of its impact on the economy. We have a huge economy. The assets of American households is $70 trillion. You're talking about spending less than 1% of the net assets of U.S. households. It's huge. Their numbers are gigantic, but it's all relative. We are a huge economy.
We might be all right. Thank you so much, Bill Smead, and we'll talk with you again next week.
Wonderful, thanks.
So